Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take us off course to make it actionable, understandable, and clear. We're back. We are back. The show goes on. Yes, we took a break. Lo siento. But we're back, and boy, what a week, what a show. We've got some excellent news items by which to equip ourselves with the truth about investing. We're going to be looking at a Wall Street Journal article about obscure Chinese stock scams that are duping many. Look at some of the patterns there. We're also going to look at our beloved international stocks. An article came out by Mr. Ben Carlson talking about currency fluctuations, currency changes. It's very interesting. I then received interesting private equity versus index fund data that deserves scrutiny, but I'm going to mention it. And we'll close with some artificial intelligence news that I was sent by a friend of the show. You're going to want to have the kids in the living room for this one. It's a jam-packed show. Let's start at the top. Headline, obscure Chinese stock scams dupe American investors by the thousands. Okay, the Justice Department is making a push to disrupt these schemes, which use social media to find buyers for risky stocks. What this article does is gives stories and details about what I call pump and dump schemes. Perhaps you've heard of this in the penny stock world. There are stocks called penny stocks. They get the name because they trade for a couple pennies per share. What happens, or what used to happen, and now it's happening again, is you'd get into some chat room. For the children of the 90s, you remember you go to these chat rooms, these message boards, and you'd hear someone say, nowadays it's a Reddit forum, hey, there's this great company, it's a penny stock, but it's about to get bought up by XYZ, come on, let's go buy it. And the person purporting to say this is a good investment already owned shares. That's the pump. Now the dump part of the pump and dump scheme is you go in and buy it along with some other people who read the same pronouncement about how great this company would be, and they sell into you. Well, this is happening with small Chinese stocks. So the Justice Department is trying to stop this, but what this article is saying is the victims of these scams are being recruited through social media ads or messages on WhatsApp. They're told to buy shares in real companies. They're obscure. These are companies, Chinese companies that were legitimate. They kind of fizzled after they went public. And here we go. These, I'll call pump and dump artists will come in and say, oh yeah, well, let's hype these up and then sell into it. So the data here is there are about 60 China-based companies that have conducted these IPOs, initial public offerings, on the NASDAQ since 2020. That's a lot. Each raised $15 million or less. Really small. So tons of volatility. What are they playing on psychologically? I think this is where we can all relate and admit we are no better than the folks who've been scammed. Hindsight's 2020. It may look easy for us, and there are stories here that you just scratch your head at, but it's the promise of outsized returns. It's the promise of hidden knowledge the market doesn't have, and therefore quick money. Now, he who gathers little by little will prosper, but wealth gained hastily will dwindle. That's the Bible's way of warning us. But implicit in most of these schemes is quick money. I'm going to buy this small, obscure, 13 cents a share type company. Boom, I'll make 10x my money in a month or something. So there's a company called China Liberal, which is enough to scare me by the name, but it ran international study programs for Chinese students. It raised $21 million from 30 big investors. Wouldn't you know it, it's a pump and dump deal. So tons of money. This seems impossible. They earned $480 million unloading 50 million shares of this thing. The Chicago U.S. Attorney's Office seized some of it. Goodness. And it talks about this college professor who was interviewed, who got caught up with it. And the professor just said, yeah, it seemed like a good deal. He's quoted by saying it just puts It just kind of puts a dent in your faith in human nature. I mean, total depravity is on offer here, and so he may hold fast to one of Calvin's tenets. It is hard to say no to the promise of quick money. And that is what these schemes are doing to investors. They are promising you quick money with a great story, and it doesn't end well. So we should always be just a little suspicious whenever someone wants to push something. You know, why the push? Why the sales? Doesn't mean that all sales are bad. Doesn't mean that all folks that are pushing an idea are bad. I push index funds. But we should be suspicious. I was talking with someone this week about private real estate investment trusts. Now, you've heard of public REITs. These are Public Storage, and Prologis is the industrial group, and many others. Public meaning they trade on a public stock exchange with shares. A lot more transparency on fees and assets. These private REITs are typically pushed. Okay? And a advisor, in every instance I've seen it, it's an advisor that is a financial advisor who has pushed the REIT onto the client. The client has not gone out and found these private REITs. Typically, there's a commission, maybe 6 to 8%, maybe more, maybe less, that these advisors will earn, quote unquote advisors. They're really salespeople. But we should all just be wise as servants, innocent as doves, when someone is pushing something on us. So here's someone's pushing these Chinese stocks. Hey, buy these stocks. This is the great. Why? Oh, here, buy into this private REIT. This private REIT's great. You got to get here. But why? In just about every instance, if someone's pushing something on you, they have some sort of profit motive. So I like the phrase trust but verify. Trust but verify. Why is someone pushing this? And unfortunately for a lot of these private REITs, they lost considerable amounts of money when interest rates rose. And with these Chinese pumping up schemes, the folks that lose all the money are the ones who believe and trust. There's a lot of that belief and trust that just gets you in all sorts of trouble. So let's keep our investing simple. Next article, Mr. Ben Carlson, How to Diversify Against the Dollar. You know, we've hit this gong how many times about the importance of international diversification and the warning that the day might come where the 100% U.S. stock investor may feel what I call FOMO, fear of missing out. Oh no, international stocks may do well. Well, this is the year. You waited like 17 years, and here it is. International stocks have started the year outperforming by a wide margin. This is Mr. Carlson's data as of June 15th. It shows Europe year to date is up 21.9%. International developed, that includes Europe and Japan and a few others, up 18% year to date. International emerging markets is up 12.6%, and the U.S. is up 2.2%. So boom, huge moves. International really is taking off like a rocket ship, like a SpaceX rocket ship. It's taken off, and we had no warning, did we? Markets don't care about our allocations. They don't wait for us to be ready. They just go. And Mr. Carlson says, how could this be? The International has no these big tech stocks that have been the real movers. How is this happening? Turns out currencies matter quite a bit. So currencies, the US dollar, the yen, and the euro, their relationship matters greatly when we look at the performance of international stocks for the American investor. So we're buying using dollars. If the euro or the yen increases in value relative to the dollar, the international holdings increase in value. So Mr. Carlson, this author, put up an interesting chart that showed how has the dollar done while international markets have ripped higher. It's dropped relative to the other currencies. It's dropped. So you have the dollar on a relative basis being worth less than the yen and the euro. Therefore, it's a huge tailwind for these international stocks. And wouldn't you know it, for the real investor, not the speculator, but the farmer. For the farmer, it will really pop come dividend time. I'm old enough to remember 2008. And in 2008, I went back for this show, for this very podcast. I said, what was the euro doing in 08? Because I remember the dividends were super high on international, particularly European stocks. Turns out the euro was ripping higher against the dollar in 08. So these ginormous dividends came in. Well, 08 was like the last time that happened. That is a long, that's a bit of a journey, isn't it? But here we go. Maybe it's going to happen again. Currency matters. This is where diversification matters. And it's quite all right. If you're 100% U.S., you're quite all right. I can already hear in the peanut gallery they're saying, but Robert, my multinational corporation that's domiciled in the U.S. gets its earning streams globally. Not just because, and to be true, I actually think you're very well diversified, having just Vanguard's total U.S. stock market, VTI, but not totally so, and psychologically not so. So Mr. Carlson just explains, hey, think about being diversified, and I would affirm that statement. Think about being diversified. It is a very hard journey to watch international stocks outperform for a long period of time. For those of you without exposure to international equities, don't worry about it. You can always hire an hourly financial advisor to walk you through the best way to get the correct allocation. I'd also add, though, you've had a great 17-year run. So, not bad. Not a bad little run. Tangential to our private REIT comment about private REITs are typically pushed. Investors aren't pulling them to themselves. Some sort of a sales force is pushing them. Well, I found data from State Street Global Markets and DataStream. These are my sources on the X.com platform. And this is so hard for me to find. It's private equity. I always struggle when people say, well, what is the performance data of private equity relative to the index fund? And ultimately, I haven't found data that I just think is rock solid, ready to go. It's not as transparent or clear what the returns are for various private equity funds, unless, of course, they're within a university endowment or pension fund where their disclosure and their returns are required. You can be in big trouble if you misstate your returns in those vehicles. So here it is. I found it. It showed over a 10-year period, the S&P 500, so that's just the S&P 500, it outperformed all PE just by a little bit. Private equity. And they don't define it in this study, but I'm going to assume these are the larger funds like the Blackstones of the world, KKRs of the world, large funds, a lot of eyes on them, not smaller private equity, large private equity. Over a 10-year period, S&P 500 outperformed. Over a 5-year period, S&P 500 outperformed. Over a 3-year period, it outperformed a lot. S&P's at like 10, PE's at like 4. And over a 1-year period, it shows the S&P 500. This is as of Q4 2024, outperforming a whole lot. I don't know that I'd take this data to the bank. Not that I doubt State Street Global Markets or DataStream, but I've seen data that shows just the opposite of this. I think there are lies, there are darn lies, and there are statistics. Sometimes there's data, darn data, and data presenting performance returns. So I'm suspicious a little bit, but it does at least, I think, remind us there's no free lunch. Oftentimes private equity is touted as this, oh, great, you lose some liquidity, you take on some fees, take on some complexity, but outsized returns. What I take people back to is Mr. David Swensen, who sadly has passed away, who was Yale's endowment chief and in many ways was the godfather of the modern endowment theory. He helped folks look to Yale as a model. He gorged on private equity. You know what he said? Buy an index fund. Can you believe that? I'll do that in meetings. When someone wants private equity or has a lot of private equity, and I'm advocating typically, hey, just let the funds roll out, or let's buy some index funds or buy deals direct, right? No middleman. I'll show the Swensen quote where he talks about just buy index funds. Very interesting, isn't it? Keeps it simple. And even if you do just the same, saves you a whole lot of trouble. And then we'll end with one of our favorite topics, artificial intelligence. I was sent this by a friend of the show, written by Crystal Kim. This is actually on a email blast. There are these big shot groups, BlackRock, The world's largest asset manager unveiled an AI platform called Asimov at the company's Investor Day in New York. Chief Operating Officer Rob Goldstein described the research platform as a virtual investment analyst that can scan text and research notes, regulatory filings, and emails to produce portfolio insights. You knew this was coming. This is probably existed for a little while. They're just not rolling it out publicly. Here we go. The AI is going to tell you what stock to buy. There's a hedge fund group, systematic hedge fund manager, Man Group AHL. They've been using machine learning techniques for over a decade. Described how the firm was using it to be more productive in July 24. So they've got chatbots helping Bridgewater Associates, another big group. They're using machine learning to make decisions, and it's delivering performance comparable to its human-led counterparts. Uh-oh. Now this is the one where, let's take our thoughts captive. Tell me why this is suspicious. Researchers at Stanford Graduate School of Business, I'm not familiar with that. It could be a feeder program for my beloved A&M. I'm not sure. Maybe you do well there for a year and you get in. Research at Stanford Graduate School of Business built an AI analyst that bested humans, beating 93% of human fund managers over 30 years by an average of 600%. The bot was fed portfolio data from about 3,300 actively managed U.S. stock mutual funds between 1990 and 2020 and nosed out alpha by tweaking fund holdings once every quarter. Now, why was that last thing I read not very interesting or helpful? Despite it maybe popping off the page, the bots did it. The bots did it. What if this whole efficient market theory is gobbledygook and the AI can actually find value? It says here, Stanford Graduate School of Business, they built this AI analyst. It bested the humans. You're reading this small print. Yes, they were using back-tested data. It was able to shoot lights out because it wasn't trying it in today's market on a go-forward basis. So, I'm suspicious. What I'm going to be looking for with this AI push is products that purport to use AI, and they may. But the rub will be to benefit you, and you must pay us more. Let us not take the bait. All you've got to do is focus on the fundamentals. Let the Schwabs and the BlackRocks and whomever else, let them try and sell you. You stick with what you know, which is keeping those costs low, that investing simple, and that time horizon long, because that's what's going to be the best shot on your investing journey. Until next week.